Well, investors are bracing, I guess, or at least looking with great interest at these corporate reports that are due this week. 150 of the S&P 500 companies are set to report, along with more than a third of the Dow components. And this could be when Wall Street really starts to get a picture of the early economic damage from the pandemic. Joining us now is Mike Pyle, Global Chief Investment Strategist, BlackRock. Mike, it's good to see you. I looked over to some of the things you're doing at BlackRock. All right. Stocks, global stocks, neutral. Global government bonds, neutral. Cash, neutral. But credit, you do have modestly overweight. And within the stocks, you're overweight U.S. equities, which is kind of interesting. And you're looking for quality. But I think cautious, or at least neutral on most asset classes, would describe your viewpoint at this time.
Thanks. Yeah, I'd say a couple of things. First, I think this is a moment of extremely heightened fundamental uncertainty, as we've been talking about around the corporate earnings season, the economics, the pandemic, what have you. But there are a handful of themes that we think will guide investors through this, and you articulated them. Up the capital structure, credit over equity, up in quality. That's true across asset classes, including high-quality equity exposures, including places like the United States over the rest of the world, and then really seeking out strong policy backstops, in particular of the kind we've seen in the United States and to some extent in China.
But Asia, you're overweight in terms of equities, as long as it's not Japan. Why?
We think that really goes to that policy theme. We think that the policy capacity that China and the United States have to throw at this crisis is just much different in scale than what we're going to be able to see from Japan and also Europe. And that, along with the underlying kind of quality and resilience of a lot of those names in the U.S., but also to some extent in China, leads us to prefer the U.S. and those non-Japanese Asian exposures, and particularly those rooted in China, over other world exposures.
But will you go down in quality for credit? Do you like corporate bonds more than U.S. government bonds?
Yeah, so we have a very strong preference right now for high-grade credit in the U.S. and Europe. Also, given the degree, again, of the ECB policy backstops there for peripheral sovereigns, Italy, Spain, we think there's a strong backstop there, and that offers a strong rationale for those. U.S. high yield is kind of right at the cusp. We prefer it. We think it's right at the edge of those policy backstops. And so it's one of those places where we do think stepping down in quality just a bit makes some sense because of what the Fed has communicated. But we recognize that that's at the periphery of the themes we've been articulating.
Why not Europe? European equities. It's just a kind of a problematic. I've always had a trouble with figuring out how you run the EU with all these disparate economies and no central fiscal authority. But you don't like European equities because of policy there? Because they seem, at least the countries seem to be emerging maybe before the United States in terms of the pandemic.
Yes, I'd say three things. One, the composition of the European equity market, much more tilted towards value names that are cheap, names that are exposed to more industrial, export-oriented parts of the economy, financials. The U.S. equity market, much more up in quality, much more exposed to those types of businesses with business models that are going to be resilient. But then secondly, you also highlight the top-down point, which is just Europe historically has not been able to muster the same degree of policy support that we've seen in the U.S., China, elsewhere. And that sort of bottom-up and top-down leads us to think that Europe is going to be a challenge exposure looking ahead.
Do you have an overall viewpoint about just, let's say, the S&P and what kind of range we see for the next 12 to 18 months?
So I'd say there's a huge tug of war right now underway between, on one hand, a set of fundamentals around the virus itself, around the economy, around corporate fundamentals that have just much bigger uncertainty around them than we've ever seen historically. On the other side, we're seeing policy support that is also historically unprecedented. I think to our way of thinking, the key thing that we need to see over the coming period of months is whether or not policymakers continue to insert significant stimulus, both on the monetary monetary side and the fiscal side to continue seeing the U.S. through what could be a pretty long road back to normal. If that happens, that's the type of signpost that we're looking at that suggests that the S&P is going to be something we want to be constructive on over the medium to long term.
You certainly don't think cash is trash either. Even though you're neutral, you call it a robust buffer against what could happen to correlated assets like stocks and bonds, I guess.
Well, it certainly has been, and that is that we expect to continue to be the case moving ahead. But again, I would just highlight that, you know, at the end of the day, we think this is an uncertain environment, but still one where some really thoughtful, targeted themes around being up the capital structure, being up in quality, seeking out those high-quality policy backstops are really going to pay off for investors over the next 6 to 12 months and beyond.